The video that many people have been asking me to make, the silver bullet protraction model, which is my 1R ATM model. I'm going to break down everything you need to know, how to enter buys, how to enter sells, where to put stop loss, take profit levels, some ways that you could potentially vary it to mimic your personal trading style, and I'll go over some examples of the model. I don't like to waste any time, no cuts. Let's get straight to the point. Silver bullet protraction model. Now, before anyone says, Gaddy, why do you have a different model? First of all, there's nothing wrong with having multiple models. Second of all, this is my exact same protraction model. The only difference in this model is I adjusted the criteria for the protraction so it can mimic what I'm trying to accomplish with this model. And what I'm trying to accomplish with this model are very simple, quick profits to accumulate winning days or help build a buffer and or recoup drawdown slowly. This model is to help you simply get that equity curve somewhat towards your favor or slowly build that equity curve with a high probability model that forms often. Most of the times it'll form 5 times in the week. At least if you're looking at the morning session and the afternoon session, it's going to form at least one of them. In the afternoon, it won't form every single afternoon, but you guys know I've been posting it in the Discord and on TikTok and whatever, me taking the model, so it usually forms. So it's a good model for that purpose. So this model is no different than my Po3 protraction model. It only demands very specific signatures to execute my protraction, to increase the simplicity and probability. Since this model, now when I trade it, I only look for 1R. You do not have to. You can use discretion, you can read price, and you can decide where you want to take your profits. But when I trade this model, I'm only looking for 1R because this is a quick, profitable model to accumulate winning days or help build a buffer on an account. That's all I'm looking for. Since this model looks for 1R, it requires very minimal trade management, and most trades are very quick. Most trades are done in a couple of minutes before 10 minutes. Now, because of this nature of this model, we want to execute on the highest probability edge of the protraction model. And that's exactly what this is. The highest probability or the best signatures that you can see in my protraction model. Now, let's get straight to the model. The timing, silver bullet window only. If you're trading it in the morning, it's 10 a.m. to 11 a.m., right? Afternoon, 2 p.m. to 3 p.m. Eastern time. Time is in Eastern time. Those are your silver bullet AM and PM time intervals. Buy criteria. You need to have a bullish bias. Do not take this model every single time it forms in either direction. You must expect the market to be predisposed to move a certain direction. It does not have to be daily bias. It does not have to be weekly bias. But I'll tell you right now exactly how to break it down. If you haven't seen my bias video, I'd recommend watching that. But let's say you didn't. This is a pretty much 30-second summary of the bias video. Go to the 4-hour and the daily chart. If you can get a bias from there, use that bias. If you cannot, go to the 15-minute chart and look for intraday order flow and intraday power of 3, so daily power of 3, to give you your bias. If you don't know what I just said, go watch the bias video and then come back. Bias is a requirement. Do not trade the model every time in every direction. It's not mechanical. Everything else is mechanical except that one part. Next, let's say you're bullish. Trades into a bullish fair value gap after the silver bullet starting window. As long as we are touching the bullish fair value gap after 10 a.m. or 2 p.m., it counts, okay? It doesn't matter if it was trading into it at 3:13:59 and then at 14 it's also inside of it. You can use that. That's fine. The only criteria is it needs to be inside or touching a bullish fair value gap after 10 a.m. or 2 p.m. Eastern time. Now, the criteria for the fair value gap itself. 1, needs to be formed inside that same trading day. I'm not using any fair value gaps from previous trading days. That's criteria 1 for the fair value gap. Criteria 2, throughout that trading day, the fair value gap must have been respected the entire time. Do not use a reclaimed fair value gap. It must be respected through the entire time. It doesn't matter if it's on the 1 minute, the 2 minute, the 5, the 6, the 13.5, it does not matter. As long as it was formed in that day, it is a bullish fair value gap and it was respected throughout that day. It doesn't matter what time it formed as long as it was inside that day and respected throughout the day. Now, ideally, best case scenario, you either have a fair value gap that formed inside the window or you have a fair value gap right before the window, let's say a 15-minute or a 5-minute. Those are like the best obvious ones because it's a very obvious continuation then. But it does not matter. Like I said, those are the criteria. Now, After we get that tap, all you need is an inversion fair value gap. Now, I actually did not include the step here. I think I deleted it by accident, but it's over here. Inversion fair value gap out of that bullish fair value gap. Does not matter what time. If you want to go down to the 15-second or 30-second and look for it, you can do that. That's okay. It's more aggressive, but that's okay, right? I did not backtest the time interval win rates. So if you have the right bias and you get the bullish fair value gap tap, you're going to be fine more times than not. I usually don't go to the seconds chart. I'm usually looking for a 1, 2, 3, 4, or 5 minute inversion. But as long as you get that inversion, it's there. Do not trade it off an order block or something else. The reason is we are looking for the highest probability edge. And when the market is not forming imbalances, it means there's a chance or a more likely chance that the market is going to go sideways. The fair value gap formation and the inversion fair value gap formation is a probability or an edge that the market is going to expand. You want to see fair value gaps form, because if we're not forming fair value gaps, it means we're wicking. And if we're wicking, it means we may not see the expansion that we're looking for. Now, we don't need much expansion with this model, but again, the highest probability edge of the protraction model is when we see imbalances form. It's not because the inversion is stronger than the order block or the break or whatever. That's not why. It's because when we see imbalances form, it's more likely to expand. It's kind of like the algorithm giving you some signatures that it's moving, right? So once we get the top of the bullish fair value gap, we want to see the inversion. Entry. This candle, we call it the inverse candle. You entry at the closing price or the opening price of the next candle. It'll be pretty much the same level. So as soon as this candle closes, do not do it before. Sometimes it'll wick at the very last second and fail. Wait for it to inverse. If you want to wait the next candle a little bit so you can get a better entry, that's completely up to you. Me, 9 out of 10 times, as soon as this candle, the inverse candle forms, I'm entering at that closing price right there. Where do you put your stop loss? You have 3 options. It's up to you if you want to be more aggressive, passive, or in the middle. Option number 1, the most recent swing low before the inversion fair value gap. That would be right here in the example. Option 2, the second candle of the inversion fair value gap, that candle's low. That's right here. Option 3, the inverse candle low. That would be this candle. It depends on how large the range is. It depends on how aggressive the market is moving. It depends on how far it inversed. It's up to you. You kind of have to read price action. Most of the time, you can still get very easy 1R just putting it at option 1. It's the safest. It's the true definitive level where the price should ideally not be trading to if the market's going to move in your favor for 1R or whatever you're aiming for. But sometimes you see this candle's really, really large and I'm like, okay, I'm not going to put it all the way down here. I'm just going to put it at option 3. You have to use that to your information. Sell criteria, very similar. Bearish bias. Trade into bearish fair value gap after 10 a.m. or 2 p.m. It can form after 10 or 2 p.m. It can form inside the window. As long as we trade into a bearish fair value gap after the silver bullet starting period, you can look for this trade. There needs to be an inversion from that leg, right? Leaving the bearish fair value gap, inversion fair value gap, doesn't matter the time frame, as long as the fair value gap was respected and the inversion forms. Entry at the inversion closing price, that would be right here. Stop loss, option 1, swing high. Option 2, the inversion second candle high. Or option 3, the inverse candle high, right? So those are your 3 options, any of those highs, okay? Next, take profit levels. 9 out of 10 times when I'm executing this, I'm just taking it at 1 risk to reward. Why am I doing this? 1, most of the time I'm at the gym or I'm at the swimming pool or at the hot tub or I'm doing something that requires attention and I'm on my phone. I can trade this model on my phone. It's the only model or the only time I'm trading on my phone. I want this trade to be quick, right? Option 2, I don't have that much time, so I won't be able to manage a trade. So when I say I'm on my phone, I'm trying to get the trade off quick. That's option 2. Option 3, I don't need more. I'm trading the morning session to look to get those big swings in my equity curve. So I don't need more from the PM session. I don't really trade this in the morning session. Now I do trade the protraction model, right? That which sometimes I will use the order block instead of the inversion. Same model, but order block instead of the inversion. But with the AM session, I'm staying there and I'm managing my trades. I'm scaling into my positions. I'm looking for larger targets because I'm there the entire time to read price, watch the candles print. With this model, it's more of a sort of set and forget 1R. Now, sometimes you can adjust your stop to break even or slightly. You can, and you can aim for more. But in this specific with model and how I'm trading it, I'm not even looking for take profit levels. I'm just saying 1R. I always have an objective because remember I have a bias. So I say, you know what, the market's probably going to trade here. I'm just going to take my 1R and leave, right? Unless it's a very, very obvious, clear, drawn liquidity, and I'm like really, really confident that it'll just go past 1R and like just spike through, then I'll extend it. But again, I just want the 1R, and I want to keep it very, very simple. Very, very simple. So take profit for me is going to be 1 risk to reward. So once you enter the trade, take out that P&L tool, stop at whatever your stop is, however many ticks, put your take profit at the same. It's a 1R trade. Very simple. You can aim for more. Most of them go more than 1R, right? But it's up to you. I like to be in and out. I want to be in the trade now within less than 10 minutes, ideally. Most of them are like 2-3 minutes. If you guys were looking at the executions when I was posting them every single day. Now, we haven't taken this model in a while because there was a bank holiday, and it was FOMC, and then Friday was quite choppy. Or Friday, the model didn't form actually in the PM session, but it forms in the AM all the time. So you can trade this in the AM as well. It's up to you. This is basically just a silver bullet model. It's a silver bullet model, and it's just slightly verified, or not verified, varied for my personal trading style and preference. Now, let's go over some examples very quickly. 2 p.m. Eastern time. Market is bearish. Let's say we had a draw on liquidity to say this low, right? This is obviously hindsight study. I don't know if I took this trade. You can go back in the journal and Discord. I may have taken this trade. I think I did, but I don't remember sure. It's all the journals and all the executions are posted in my Discord for free. You can go check, or you can check my TikTok. I always post every trade I take. Very simple. We trade into a bearish fair value gap. I think I do remember this. I think I did take this one. We trade into a bearish fair value gap after 2 p.m. We're bearish, so criteria 1, criteria 2. Inversion fair value gap, right? This is criteria 3. Boom. How do you take the trade? So you would enter on that candle's closing price. Your stop loss can go either, what did we say? Option 1, the swing high. Option 2, the second candle high, so right there. So that's option 1, option 2, option 3, the inverse candle high. And it looks like you also wouldn't have been stopped out. So let's just say we use the swing high. 1R would be right there. So after the inversion, you get 1R right there. Now, if you notice, the model actually formed again. So if you see, right, we tapped into a bearish fair value gap, that's your inversion. Let's scratch this out and let's mark out this now. So the model formed again. There's another little setup right here. It's small. Now, let me double check before I seem like a fool. Okay, sorry. It looks like it actually did not form because there's no inversion fair value gap there. Not on this time frame, at least. There's probably one on another time frame, but not on that time frame. So that would be the model right there. And then you can see 1R, very simple, 2, 3R. That would have been like a 4 or 5R trade. So let's say you were really confident in, I don't know, this is morning session low. Yeah, you could have held it. But for me personally, I took this at 1R and I was very happy and content, and I just tapered the rest. So that's one example. I think I have one other red line here. And again, I'm not going to go over so many examples because I've literally posted this execution, and in my Discord, there are multiple examples where I'm calling it repeatedly. So you can just go look there if you want to see me actually take the trade live. And there's not much management. It's just pretty much I enter and it goes straight to TP. But if you want to study that, then you completely can, right? So we have bearish order flow going into the market, right? Say you had some sort of draw. Again, this is a hindsight study. I don't think I took this one, but we're just here to study. Very, very simple, right? Bearish fair value gap, taps. We have an inversion fair value gap right there. That's your entry. So where would your entry be? Right? Now there's 2 entries here actually. So entry 1 would look like this. Now because the displacement is so large, this would be a good time to use the minimum stop loss, right? So in this case, I don't even think you can get 1R. So if you entered right here, you actually don't get 1R, right? If you got a better fill, and I'll explain this to you right now because the model formed again. If you got a better fill, so let's say this candle closed and you just waited a little bit, waited a couple seconds, and you got a fill, I don't know, let's say you got a fill somewhere in this candle's body, then you would have very easily gotten 1R, right? But the model formed again. So let me demonstrate. Bearish fair value gap right here, and then this is 1440. If you look at the candle, the time at the bottom, so it's still valid. And then there's an inversion right there. You see that inversion. So again, entry on the inverse candle. So you put the stop at the high, and this one was a very easy 1R. So what could you do in a situation like this? Well, you see that this model formed and then you see it play out again. This is where you could actually scale. Now this happens sometimes, and in which case you would have very easily gotten 1R, because you can reduce your risk from here to here, and then you can add a position to mimic your original risk, right? So those are two examples of the model forming. I don't want this video to be any longer than it has to be. Like I said, if you want to see examples of me execute the model live, there's no point in me just keep going back and doing hindsight study. That's for you guys to do if you want to take this model and add it to your arsenal. You guys got to go back and do the hindsight study. If you want to see me execute it live, in the Discord, I posted the trade recaps, or I post the, little P&L thing where you can watch the trade tick up and down, and I'll say stuff like 1R, silver bullet, protraction, ATM model, whatever. So on TikTok, in my Discord, all the executions, all the journals are there. If you want to go look at them before you say hindsight or anything. And then obviously, if you want to backtest it yourself, you would just do that exactly in hindsight. So I appreciate you guys coming through for this video. I am currently on vacation, so when you're watching this, it is a pre-upload. So right now, the date is Saturday, June 21st. However, you'll probably be watching this on Monday or Tuesday. And if you are watching this, there is going to be no live streams on the 22nd. Wait, let me double check that information. Sorry, no live streams on the 24th, 25th, and 26th, right? On the 23rd, I will be live. I will be going on my vacation right after stream. 24th, 25th, 26th, no trading live streams. So I hope you guys, wish me a good time, and I'll see you guys back on Friday. So we're going to stream on Monday. We're going to stream on Friday. In between the week, no trading. However, in the free Discord, I will post all my outlooks, all my trades. I'll post my P&L and my executions, and I'll probably make any videos of any trades I took, win or lose, as always. So if you guys want to stay tuned for that in the free Discord, and I will see you guys next time. Peace.